Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, let's get right into it.
So what if I told you that the absolute safest part of your retirement account, like the part that's designed specifically to protect you from a stock market crash, actually has a hidden trap door built right into it?
Right, which sounds crazy, but it's true.
It is. Because for decades, there's been this golden rule of investing, the ultimate set it and forget it strategy that everyday Americans they've treated it like gospel.
The classic 60-40 portfolio.
Exactly. You put 60% of your money into the stock market to grow your wealth, and you put 40% into bonds to keep it safe.
Yeah, I mean, it was treated as the perfect recipe, right? Like a financial slow cooker. You just throw those two ingredients in, turn it on, and...
And 30 years later, you retire on a beach.
Exactly. But based on a really fascinating stack of recent analysis we're looking at today, pulling from the IMF, AQR Capital Management, and Societe Generale, that golden rule is, well, it's fundamentally shifting.
And I think that's our mission for this deep dive.
Yeah.
We really need to figure out why your bonds are no longer acting as that automatic safety net for your stocks.
Right.
And more importantly, how you, as an everyday investor listening right now, how you need to rethink your whole financial defense playbook, but without needing a PhD in Wall Street jargon to do it.
Which is such a critical mission.
Yeah.
Because, let's be clear, right up front, bonds are not dead.
Right. They aren't totally useless now.
No. They haven't suddenly become this toxic asset, but they're suffering from a condition that analysts call false diversification.
Yeah.
And understanding what that means is it's absolutely vital for protecting your hard-earned money in today's economy.
Okay, so let's unpack that. I always like to visualize the classic 60-40 portfolio like a playground seesaw.
Oh, that's a good way to look at it.
Yeah, so on one side you have your stocks, and on the other side you have your government bonds. Historically, when the stock market took a massive dive like during a sudden recession, the seesaw tilted.
Stocks slammed down.
Stocks slammed down, but bonds go up. They acted like this automatic shock absorber for your 401k.
And, for a really long time, that seesaw dynamic worked flawlessly. I mean, when panic hit the stock market, investors would just rush to buy government bonds because they were viewed as the ultimate safe haven.
Because the government is always good for the money.
Right, exactly. So all that sudden demand pushed bond prices up, which nicely cushioned the blow from your plummeting stocks.
Yeah.
But, and this is the scary part, when you dig into the recent data, specifically a February 2026 report from the International Monetary Fund, that seesaw mechanism has basically been broken since 2020.
Wait, when you say broken, like what are we actually looking at here? Did the seesaw just stop moving altogether?
No, it's actually much worse than that.
Oh, great.
Yeah, both sides of the seesaw are slamming into the dirt at the exact same time.
Oh, wow.
Yeah, the IMF pointed out that over the last few years, we're increasingly seeing stocks and bonds plummet together during market drops. The traditional protection you thought you had in that 40% of your portfolio, it simply hasn't been there when the market panicked.
But why the sudden change? I mean, it's not like bonds just woke up one day and forgot how to function, right?
No, the bonds are doing exactly what they've always done. The issue is that the macroeconomic weather has completely changed.
Now, so?
Well, bonds are fantastic at defending your money against an economic recession or, deflation periods where economic growth just grinds to a halt and consumer prices drop.
Right.
But recently, the American economy has been fighting a totally different set of villains. We're talking about lingering supply chain shocks, persistent inflation, central banks rapidly hiking interest rates, and growing government deficits.
Which we're definitely seeing right now.
Exactly. I mean, the current environment under the Trump administration involves significant government spending and deficits, which changes the dynamic completely.
And inflation is basically kryptonite for a bond, isn't it?
Oh, it destroys them. Let's break down the mechanics of why. A bond is essentially just a promise that the government or a corporation will pay you a fixed amount of money over a set period of time.
Okay.
So if inflation spikes, the cost of your groceries, gas, housing it, all skyrockets. But your bond is still paying you that exact same fixed flat dollar amount.
Ah, so the actual purchasing power of that bond just gets eaten alive.
Exactly. So when inflation hits, the value of those bonds falls. And because inflation also eats into corporate profit margins, well, stock prices fall too.
So suddenly, the same villain is attacking both sides of your seesaw.
You got it.
I want to push back on our own expectations here for a second. Are we just asking bonds to do too much?
What do you mean?
Well, It sounds to me like everyday investors bought a tool expecting it to be a Swiss Army knife, right? Like we wanted this one asset to generate income, keep our principal safe, and protect us from stock market crashes all at the exact same time.
Yeah, that's a really common trap.
But in reality, a bond is just a regular screwdriver. It only does one specific job.
That is the core of the problem right there. We've lumped all bonds into one massive safe bucket without understanding their specific jobs.
Right.
I mean, short-term bonds like a 3-month treasury bill and long-term bonds like a 30-year treasury bond, they do completely different things.
Right. They aren't the same tool.
Exactly. Short-term bonds are basically cash equivalents. They're great for keeping your money liquid and earning a little bit of interest. Long-term bonds, on the other hand, are a valid hedge against a deep deflationary recession.
But not inflation.
Right. When you face an inflation shock, or when the government is running those massive deficits we talked about, those long-term bonds will completely fail you as a safety net.
So if you don't make that distinction, you fall right into that trap of false diversification. You look at your retirement account, you see a big chunk of bonds, and you think you're safe. But you're actually completely exposed.
Completely exposed.
Let's get into the hard numbers on this because there's some recent analysis from AQR Capital Management. This is from April 2026, and it really puts this into perspective. They looked at the 5-year period ending on February 28, 2026, measuring the relationship between government bonds and the S&P 500.
Yeah, and the metric they use to measure that relationship is called correlation.
Right, correlation.
So a correlation of 1.0 means two assets move identically in lockstep. A correlation of negative 1.0 means they move in exact opposite directions.
Which is the perfect seesaw we all want.
Exactly. But what AQR found is that over the last 5 years, the correlation between stocks and bonds was a positive 0.53.
Positive 0.53, meaning more often than not, stocks and bonds are just holding hands and walking in the exact same direction.
Yeah.
If stocks trip and fall, your bonds are tripping and falling right next to them.
That's the reality of the data. But the AQR research highlights an even more revealing statistic. They looked at something called equity beta.
Okay, what's that?
In simple terms, beta measures how much a specific asset reacts to the broader stock market. They found that bonds currently have an equity beta of 0.19.
0.19. Okay, let me translate that for the listener, because this is where the hidden trapdoor really opens up.
Go for it.
Imagine you hold $1 in bonds. Because of that 0.19 beta, you actually have 19 cents of hidden exposure to the stock market inside that bond.
Yep.
It's like going to a restaurant, ordering a strict 100% vegetarian meal, and then finding out the chef cooked it in 19% beef broth.
That is a very visceral way to put it.
But it's true, right? You thought you were totally protected from the meat, or in this case, the stock market, but you aren't. You're eating the beef broth.
It captures the danger perfectly. You assume your 40% bond allocation is totally walled off from the stock market. But because inflation is tying their fates together, stock market risk is just leaking directly into your safe bucket.
And if we zoom out to the global financial system, the implications here are massive, right?
Oh, huge. Think about gigantic pension funds or multinational insurance companies or those really popular target date retirement funds that automatically adjust your investments as you get older.
Everyone has those in their 401k.
Right. And their entire mathematical foundation is built on the assumption that bonds will automatically offset stock losses.
So their whole foundation is built on a seesaw that is currently broken.
Yes. And the IMF was very explicit in warning about this structural risk. If bonds and stocks keep falling together, these massive multi-billion-dollar funds might find themselves violating their own internal risk limits.
And what happens then?
Well, to fix it, they could be forced to rapidly sell off huge chunks of their assets just to cover losses.
Wow.
Yeah, that kind of forced panic selling can create severe volatility across the entire global market. It turns a bad day on Wall Street into a full-blown systemic crisis.
Okay, I'm thoroughly spoofed now. But practically speaking, I'm not running a multi-billion-dollar pension fund.
Right.
I'm just trying to protect my own savings. So if bonds aren't offering that negative correlation to save us when stocks fall, what is? If the traditional shield is broken, what do everyday investors use for defense?
Well, the research points toward an alternative strategy known as managed futures.
Managed futures. Okay.
And I want to be clear right away that this isn't a new asset class. It's not a stock and it's not a bond. It's an entirely different type of strategy.
How does it work?
So, managed futures isn't about buying an asset and just holding it for 30 years hoping the price goes up. It's a strategy that looks at the current trends across global markets, whether it's stocks, bonds, currencies, or commodities like oil and gold,
Hmm.
and simply rides the momentum of that trend.
Wait, hold on. Managed futures. That sounds incredibly risky and speculative compared to a boring government bond. Are you seriously suggesting everyday investors try to day trade oil and gold to protect their retirement?
No, no, not at all. Everyday investors shouldn't be day trading anything.
Okay, good. Just checking.
Managed future strategies are run by large institutional algorithms and professional managers. The core concept is actually quite simple. If a trend is clearly moving up, the strategy buys into it.
Okay.
If a trend is clearly moving down, the strategy can easily bet against it and make a profit as the price
Well,
falls.
taking a short position, right? Betting that the price will drop.
Correct. And they use futures contracts to do this. A futures contract is literally just an agreement to buy or sell something at a specific price at a specific time in the future.
So you don't actually own the thing.
Exactly. Because you are just making an agreement, you don't have to buy the actual barrels of oil or the physical bars of gold.
Right.
You are just trading the contract based on where the price is trending.
Okay, I think I get it.
Mm.
So instead of building a sturdy house and just sitting inside hoping it survives a financial hurricane, this strategy is more like hopping on a surfboard.
I like that.
Yeah, you don't care which way the water is moving. You don't care if it's high tide or low tide. You just want to catch whatever wave is currently forming and ride the momentum.
The surfboard analogy captures the essence of trend following perfectly. Managed futures managers don't care if the overall economy is booming or busting, they just follow the data.
Right.
If the data says inflation is rising and bond prices are locked in a downward spiral, they will short those bonds and ride that downward trend for profit.
And does the recent data actually validate this approach?
It does. Societe Generale tracks these kinds of strategies, and according to their data, their trend index had a correlation to the S&P 500 of a negative 0.28 over the last 5 years.
Wow, okay. So while regular bonds had a positive 0.53 correlation, meaning they were falling right alongside stocks,
Yeah,
the managed future strategies were sitting at negative 0.28.
exactly.
They were actually providing that seesaw effect.
Yes. And as of late May 2026, the Societe Generale Trend Index was up 10.55% for the year.
10.55%.
Yeah. During the intense volatility we saw in early 2026, the strategy acted as both a defense mechanism and a profit engine when traditional assets were just, really struggling.
Okay, that sounds amazing, but let's take a breath. There is no such thing as a magical, always goes up investment.
Definitely not.
Wall Street doesn't hand out free lunches. And the AQR research actually mentioned something about this strategy failing in whipsaw markets. I've heard the term whipsaw before, but what does that actually look like in my portfolio?
It's a crucial vulnerability to understand. A whipsaw market is when prices violently jump back and forth without ever establishing a clear direction.
Okay.
Imagine the stock market goes up 2% on Monday, down 2% on Tuesday, up again on Wednesday, and then crashes on Thursday.
Oh, so the surfboard just keeps wiping out.
Exactly. The trend-following algorithm might see Monday's jump and buy into what it thinks is a rising trend, only for the market to instantly reverse on Tuesday, resulting in a loss.
Right, because there's no wave to catch.
Exactly. Because there is no sustained momentum, the strategy just gets chopped up. So managed futures is not an automatic insurance policy that pays out the second the stock market drops. It's much better to think of it as trend insurance.
Trend insurance.
Yeah, it pays out when the market experiences prolonged shifting trends, like a long, slow bleed caused by inflation.
That makes a lot of sense. But I still have a very practical challenge to this whole concept.
Let's hear it.
Let's say I'm an everyday investor. I'm used to my bonds paying me a steady, safe interest rate every single month.
Right.
If I take a chunk of my money out of traditional bonds to put into these managed futures to catch these waves, aren't I giving up all that nice, safe interest I could be earning?
That is the exact question investors should be asking right now, and the answer reveals one of the most fascinating mechanical aspects of how managed futures operate today.
Okay.
Remember how we talked about futures contracts being an agreement rather than buying the physical asset?
Right. You're not buying the actual oil.
Because of that, the strategy is incredibly cash efficient. To enter a futures contract, you only need to put down a small fraction of the total value as a margin or, a deposit.
Let me see if I can translate that. It sounds kind of like renting an apartment. You put down a 5% security deposit to control the entire apartment. You hold the keys, but you can leave the other 95% of your money sitting safely in your own bank account.
That's a brilliant way to frame it. The managed futures fund uses a very small amount of its total cash, maybe 10 or 15%, to place those surfboard bets across the global markets.
And the rest of the cash.
The rest of the cash, the collateral, just sits there. But it doesn't sit under a mattress. In typical exchange-traded fund structures for these strategies, that massive pile of leftover cash is invested in ultra-safe, short-term government debt.
Okay.
Specifically, treasury bills or T-bills.
Oh, and because of the economic environment we are in right now, those T-bills are actually paying a decent return.
Exactly.
Yeah, according to the latest Federal Reserve data from May 2026, three-month Treasury bills are yielding roughly 3.6%.
Which means the leftover cash sitting in the background of the managed futures fund is actively earning a solid 3.6% yield.
That's incredible.
It is. And this is a massive fundamental shift from the investing environment of the 2010s. Back then, central banks kept interest rates anchored near zero.
Right, money was essentially free.
Right. So if you invested in managed futures a decade ago, that leftover cash collateral was earning practically nothing. You had to rely 100% on the manager catching a wave to make any money.
But
Today, because short-term rates are elevated, that 3.6% yield acts as a baseline of income beneath the trend-following strategy.
I mean, that makes moving some money out of traditional bonds much less painful because you aren't completely sacrificing your interest income.
Exactly.
But, okay, we need to put up a huge flashing neon warning sign right here.
Please do.
Let me be the voice of caution for the listener. Having a 3.6% yield on the cash collateral does not mean you have a guaranteed 3.6% return on your investment.
I cannot stress that enough. That is a critical disclaimer.
Right, because if the trend-following strategy guesses wrong, like if it wipes out in a whipsaw market and generates trading losses, those losses will eat right through that 3.6% interest.
Yep.
It might eat deeply into your principal investment, too. So, do not mistake a managed futures ETF for a principal-protected high-yield savings account. It is an active investing strategy with real downside risks.
Completely agree. The interest is a nice buffer that helps smooth out the ride, but it absolutely does not eliminate the risk of the trading strategy itself.
Okay, so I'm convinced that the old rules are broken and that there are new tools available. But practically speaking, I'm not going to liquidate my entire 401k tomorrow and start over.
No, definitely don't do that.
How do we actually start making these adjustments without tearing down our entire portfolio?
The first step is really just a mental shift. You need to focus on what economic risks you are actually exposed to, rather than just looking at the names of the assets you own.
What do you mean by that?
Well, the AQR research highlighted a very common trap. People often think they are safely diversified because they bought a bunch of different trendy things. You know, they buy some private credit, maybe a downside buffer fund, and throw in a little Bitcoin for good measure.
Oh, I know plenty of people who do exactly this. They
Mm.
proudly show off their portfolio, and it's got like 15 different mutual funds and crypto tokens in it, and they feel incredibly protected.
It feels like diversification, sure, but the analysis shows that many of those alternative assets carry the exact same hidden stock market risk as bonds do right now.
The beef broth.
The beef broth.
Yeah.
They have high equity beta. If the broader economy takes a massive hit, private credit, buffer funds, and crypto are all highly likely to drop right alongside the S&P 500.
So you haven't actually diversified your risk.
No, you've just bought 15 different tickets to the exact same sinking ship.
Wow. Okay, so what does the new playbook look like then? If the 60-40 rule needs an update, how do we redefine the roles of our investments moving forward?
We need to assign specific jobs to specific buckets of money. First, for liquidity and stable income with very low volatility, you use short-term treasury bills. They are currently paying well, and they do not carry the massive inflation risk that long-term bonds do.
Got it. T-bills for everyday safety and income.
Second, do not throw all your long-term bonds away. Keep them, but understand their strict, narrow job.
Which is?
They are there purely for deep recession protection. If the economy grinds to a complete halt and central banks are forced to slash interest rates back to zero, those long-term bonds will absolutely save you.
And the third bucket. Where do managed futures fit into this new architecture?
Consider managed futures as your trend insurance. They defend against the prolonged inflation shocks and the major long-term shifts in market structure that traditional bonds just fail to catch.
But you aren't putting half your portfolio on them.
No, no, you do not need to put half your life savings into them. The research suggests treating them as a satellite slice of your overall portfolio, maybe somewhere between 5 and 15%.
Yep.
You take a little bit of money from the bond side of your portfolio that was overly exposed to inflation, and you reallocate it here to bring true, non-correlated diversification back into the mix.
That feels incredibly manageable. It's not about panicking, it's just about adjusting the sails.
Exactly.
But let me do a final check here for everyone listening. Managed futures are not a total replacement for your bonds. They're just a replacement for some of the specific jobs that bonds used to do back before inflation broke the seesaw.
Spot on.
Also, if you decide to explore this and look into buying a managed futures strategy through an ETF on the stock market, you really have to do your homework. These are complex, actively managed strategies.
Oh, absolutely.
You must watch out for hidden costs. Look closely at the management fees. Look into something called rollover costs,
Yeah.
which is the fee the fund pays to continuously update those futures contracts. Depending on how the specific ETF is built, those internal fees can vary wildly and take a really big bite out of your returns over time.
That is excellent advice. The era of just blindly buying two massive index funds and never looking at them again might be pausing. This new economic era requires paying a bit more attention to what is actually happening under the hood of your portfolio.
And that leads me to a final question I want you to chew on after this deep dive ends. Take a hard look at your own retirement account this week. You might own 10 different mutual funds, and you might feel really proud of how diversified you are. But ask yourself, if a new inflation shock hits tomorrow, or the market takes a sudden violent left turn, are those 10 funds actually doing 10 completely different jobs? Or are they all just going to fall off the exact same cliff together? Don't forget to subscribe and hit that like button.